If you're like me, you probably, walk past those massive air conditioning units sitting on top of office buildings.
No, yeah. Or humming behind the grocery store.
Exactly. And you just don't give them a second thought. I mean, you think of heating, ventilation, and air conditioning HVAC as this incredibly mundane, mature, maybe even like sleepy industry.
Right. It's just metal boxes, fans, and Freon.
Yeah, but today we are looking at a stack of sources that just completely shatters that illusion. We are pulling apart the Q2 2026 earnings report and the executive presentation from Trane Technologies.
Trading under the ticker TT on the New York Stock Exchange.
That's the one. They are a massive global climate innovator, the parent company behind household names like Trane and Thermo King. And the mission for this deep dive is to figure out how a legacy physical infrastructure company is suddenly posting growth numbers that look more like, I don't know, a Silicon Valley software startup.
It really is wild when you look at it.
Right. So, okay, let's unpack this because we are going to look at why their demand is exploding, how they are navigating some very turbulent global geopolitical headwinds, and what their staggering $12.1 billion backlog tells us about the direction of the global economy.
Yeah, it is a fascinating set of documents. And it really forces us to challenge our underlying assumptions about where the most explosive growth in the market is actually happening right now.
Mm-hmm.
Because we tend to get so blinded by the digital realm, software advancements, that we forget the physical world is bearing the load of all that progress. And that physical load requires heavy engineering.
It really does. And I want to start straight at the top with the headline numbers because I want you listening to see exactly why this earnings report stands out so starkly. The numbers are huge. Seriously. For a company of this size, operating in industrial manufacturing, you typically expect steady, slow, maybe single-digit growth.
Right, like a modest dividend, some incremental year-over-year progress.
Exactly. Instead, Trane Technologies reported record organic bookings up 37% globally.
37%.
Just think about that scale for a second. 37% more orders coming through the door compared to the same time last year.
Yeah.
And that surge pushed their total backlog, which, just to be clear, is the amount of work they have been hired to do but haven't yet billed for because they haven't finished building it. It pushed that backlog to a record-breaking $12.1 billion.
Which is insane.
I mean, that backlog alone is up 70% year over year.
Yeah, and those future orders are also translating into massive top and bottom line success right now. I mean, the sources show their Q2 revenues hit $6.4 billion, with organic revenue up 9%.
Wow.
And their adjusted continuing earnings per share, or EPS, reached $4.31. That's an 11% jump.
So they aren't just taking orders and, bottlenecking?
No, not at all. They're actively executing shipping products and delivering profitability today.
Right. But, within all those massive enterprise-wide numbers, there is one metric in the executive presentation that literally made me stop and reread the page.
I think I know which one you're talking about.
Probably. When you look at their America segment, specifically their commercial HVAC applied equipment bookings, the growth was a staggering 130%.
It jumps right off the page.
Wait, 130% growth in applied equipment? That sounds like an AI startup's growth chart, not an air conditioning manufacturer. I mean, software can scale that fast because it's just code being replicated on a server.
Right.
But how is a company manufacturing heavy, highly complex metal boxes scaling at that speed? What on earth is driving that kind of demand?
Well, that is the pivotal question of this entire report. And the short answer is that you are actually looking at an AI startup growth chart, just viewed through the lens of physical infrastructure.
Okay, walk me through that.
Yeah, so if we look closely at the management commentary and the vertical markets highlighted in the presentation, they point directly to data centers, high-tech industrial manufacturing, and K-12 education as their core growth drivers.
Right.
But it's those first two, and data centers in particular, that really explain the hypergrowth in applied equipment.
Because of the servers required to run artificial intelligence.
Yes, exactly. And it's important to understand the mechanics of why that matters to an HVAC company. We are in the middle of a massive global build-out of artificial intelligence and digital infrastructure.
Right, which takes a lot of power.
Immense computational power. And those specialized servers run incredibly hot, like much hotter than a standard cloud storage server.
So it's a completely different scale of heat.
Oh, totally. Trying to cool an AI data center with traditional air conditioning is like trying to put out a localized campfire by turning down the thermostat in your living room.
That's a great image.
It just doesn't work. The heat is way too concentrated.
So you can't just blow cold air into the room and hope for the best.
Not at all. These facilities require highly customized, heavily engineered cooling solutions to prevent the servers from literally melting down. And that's what applied equipment means in this context.
Got it. So it's not like a standard unit.
No, it's not a window unit or a standard rooftop box. It's a bespoke, massive-scale thermal management system.
Yeah.
We're talking about like liquid cooling loops that run directly to the server racks, sophisticated heat exchangers, and systems designed to capture and redirect waste heat.
That is just wild.
Yeah, Trane is sitting right at the center of the AI boom because without their advanced cooling technologies, the digital revolution physically cannot scale.
That is such a huge paradigm shift. I mean, you literally can't run the large language models or the advanced AI software without the heavy metal, the chillers, and the thermodynamics that Trane provides.
Exactly.
Which, brings up a really interesting operational puzzle. Because if bookings are exploding like that in the Americas, and I think the report notes overall, America's bookings were up 44% and revenues up 12%.
Yep, that's right.
You would naturally assume their profits are completely unconstrained. You picture the money just falling straight to the bottom line. But when we pivot to look at their profitability metrics, something entirely different is happening.
Yeah, the margins tell a much more nuanced story about management's strategic priorities than the revenue line does.
They really do. Because despite the massive revenue jump in the Americas, the adjusted EBITDA margin actually dropped by 50 basis points to 23.5%.
Right.
And let's just translate that jargon for a second for anyone listening. EBITDA is basically the cash they generate purely from running the operational business before taxes and interest get involved.
Exactly.
And a basis point is just finance speak for 1/100%.
Mhm.
So when they say margins drop 50 basis points, they mean their operational profit margin actually shrank by 0.5%.
Yeah, which seems counterintuitive.
Totally. And the sources explicitly attribute this margin squeeze to a few things. Inflation, supply chain challenges like expedited freight and spot buys, but most importantly, what they call accelerated investments.
And that is a deliberate, critical, strategic choice by management that we really need to unpack. Because, Wall Street is notoriously short-sighted and usually punishes companies for any kind of margin compression.
Right. They hate to see margins slip. I was trying to wrap my head around why they would willingly let margins drop when demand is this high, and I came up with an analogy.
Okay, let's hear it.
It's like a popular restaurant that has a line out the door every single night.
Sure.
The owner could just squeeze every penny out of the current setup, overwork the staff, cram tables together, and pocket all the cash to show a massive profit margin tonight.
Right, maximize the short term.
Exactly. But instead of doing that, they're taking a short-term hit to their profit margins to knock down a wall, expand the kitchen, and hire more chefs so they can serve twice as many people next year.
That restaurant analogy perfectly captures the data we are seeing in these sources. Trane is deliberately ramping up investments in 3 specific areas: capacity, innovation, and operational excellence projects. I mean, they have a $12.1 billion backlog. If they don't expand their kitchen, so to speak, they will never be able to physically fulfill those orders. And those massive data center customers will eventually go to a competitor.
Yeah, that makes total sense. But what about those supply chain costs? Because the report mentioned expedited freight and spot buys dragging down the margin. How does that fit into the strategy?
Well, it comes down to prioritizing delivery over absolute cost efficiency.
Okay.
So, a spot buy happens when a critical part is delayed by your normal supplier, rather than telling your customer that the massive cooling unit for their new billion-dollar data center is going to be 3 months late.
Which they would not want to hear.
Exactly.
Okay.
Instead of doing that, you go out to the open market, the spot market, and you pay a hefty premium to get that part today.
Oh, I see.
And expedited freight is the same concept. You pay extra to fly a component in rather than putting it on a slow cargo ship. They're willing to eat those higher logistical costs to protect their delivery timelines and capture market share.
So they're actively choosing future market dominance over a tiny bump in today's margin.
Yeah, exactly.
That's fascinating. And it actually explains a specific acquisition mentioned in the sources, right? The report notes they are on pace to deliver about $500 million in revenue just from their Stellar Energy acquisition in 2026.
Yes.
And they are ramping that up to a $1 billion run rate by 2028. And, Run rate just meaning if you took their monthly performance and stretched it over a full year, it would equal $1 billion.
Right, a massive acceleration.
Yeah, you don't double the output of an acquired company in 2 years without massively investing in their capacity today.
Exactly. They are looking at that 130% growth in applied equipment and realizing, this isn't just a one-off spike.
Right.
It's a structural, permanent shift in demand. And you only take a margin hit to expand capacity if you truly believe the demand is durable for the long haul.
Right. But expanding that kitchen isn't just a matter of spending money, it's about physical logistics. And building heavy physical infrastructure makes you incredibly vulnerable to global realities,
Clearly does.
which is exactly what Trane ran into this quarter. Because they aren't just a North American company, they are a global player. And while the Americas are acting like an absolute powerhouse right now, the global stage is a lot more complicated.
Yeah, definitely.
We need to look at how the company is buffering against geopolitical volatility, specifically in the EMEA region, so Europe, the Middle East, and Africa.
Yeah, the EMEA segment had a demonstrably tough quarter, and the earnings presentation is highly transparent about the root causes of that friction.
Yeah, the numbers are stark compared to the Americas. In EMEA, reported revenues were down 1% and organic revenues were down 4%. But the real hit was to profitability. Their adjusted EBITDA margin in EMEA plummeted 360 basis points, so 3.6% down to 14.7%.
Wow.
And the sources explicitly cite the ongoing conflict in the Middle East as a major direct headwind.
Yeah, they estimate it cost them about $30 million in operating income in the first half of the year.
Wow.
And they are projecting a negative $100 million revenue impact in the second half of the year.
100 million.
Yeah, and because of this, Trane had to take action in late Q2 to right-size their cost structure in the Middle East for the lower revenues they are expecting.
It is a very grounding reminder that while we often talk about these multinational corporations as if they exist in a frictionless financial vacuum, they are deeply tethered to physical realities on the ground.
Absolutely. When regional stability fractures, it isn't just a news headline for a company like Trane. It mechanically breaks their business model in that region.
Right, like shipping lanes getting choked.
Exactly. Shipping lanes get choked, causing freight costs to triple. Large-scale construction sites are paused by nervous developers. And suddenly, your local offices are sitting on inventory they can't deliver, but you still have to pay the staff and maintain the facilities. Trane is having to actively manage their overhead in real time to adapt to a geopolitical situation completely outside of their control.
And it's not just the Middle East causing friction. When we look at their Asia-Pacific or APAC segment, the overall numbers look great, like revenues are up 11% organically.
Right, which sounds fantastic on the surface.
Yeah, but underneath that average, it's really a tale of two entirely different markets. The sources note that bookings in the rest of Asia region are up over 70%, which is incredible.
It is.
But in China, they are experiencing a low double-digit drop in bookings.
Yeah, China remains a highly dynamic and complex market right now, particularly when you look at commercial real estate and large-scale infrastructure investments, which are, traditional strongholds for HVAC demand.
Right. Which actually makes me wonder about their overall corporate structure. Well, looking at the geopolitical drag in EMEA and the slowdown in China, is their global footprint actually a liability right now? I mean, if they were just a domestic U.S. company focused entirely on the Americas, their overall enterprise margins would look significantly better. So is being spread out across the world dragging down the absolute runaway success of their Americas segment?
Well, it's tempting to look at the math and jump to that conclusion. Because yes, those regional numbers are pulling down the global averages.
Right.
But if we analyze the enterprise strategy as a whole, this quarter actually highlights the immense protective value of geographic diversification.
Okay, walk me through that, because on paper it looks like dead weight.
Right, but think about it from a strict risk management perspective. No single market stays red hot forever, and no region is completely immune to sudden economic or geopolitical shocks. If Trane were heavily concentrated in Europe and China right now, this earnings report would be a disaster. The stock would likely be taking a massive hit. But because they are globally balanced, the unprecedented strength in the Americas, and that 70% bookings growth in the rest of Asia, it acts as an ultimate shock absorber.
So they're basically outrunning the regional anchors.
Exactly. The surging demand in one hemisphere is more than covering the localized shortfalls in another. It allows the enterprise as a whole to not just survive these regional shocks, but to actively thrive.
Wow.
In fact, the overall enterprise is performing so well that despite the $100 million revenue headwind projected for the Middle East, management actually felt confident enough to raise their full-year guidance for the entire company.
That is a fascinating way to look at it. The global footprint isn't an anchor, it's a diversified portfolio protecting the core business.
Exactly.
Which is a perfect transition because having looked at the operational bookings, the supply chain investments, and the regional drama, we need to zoom out to the ultimate scorecard for any business.
Right, the cash.
Yes, we need to talk about the cash flywheel because at the end of the day, you can have all the bookings in the world and you can have a great strategic moat, but if you aren't actually generating cash, you don't have a sustainable business.
Cash flow is the ultimate truth teller in financial reporting.
Hmm.
It strips away all the accounting adjustments and shows you exactly how much actual money is flowing into the bank accounts.
And Trane's Truth is looking pretty robust. According to the report, their year-to-date free cash flow is a massive $1.6 billion.
Yeah, that's huge.
Right. If you're an investor listening to this, this is the exact metric you want to see to prove that the 130% growth in applied equipment isn't just a flash in the pan. The cash is real.
It's very real.
And what management is doing with that cash is just as important. They are aggressively returning capital to shareholders. The presentation outlines that they are tracking to deploy between $2.8 and $3.3 billion in 2026 alone. Yeah. That includes $690 million in dividends, $840 million in share repurchases, and another $340 million slated for M&A and strategic investments.
It's just a textbook example of a balanced, highly effective capital allocation strategy. I mean, they are generating so much cash from their daily operations that they don't have to choose between competing priorities.
Right.
They can comfortably afford to take the margin hit to expand the kitchen with capacity investments. They can acquire new technologies like stellar energy, and they can still hand billions of dollars back to their investors through dividends and stock buybacks.
Yeah.
Achieving that combination of high growth reinvestment and massive capital return is incredibly rare in the heavy industrial sector.
And because of all this operational strength and cash generation in Q2, they updated their scorecard for the rest of the year. They raised their full year 2026 guidance.
Which is always a good sign.
Definitely. Originally, they were projecting around 7% organic revenue growth. Now they expect organic revenue growth to be approximately 9%. And they bumped up their adjusted EPS guidance to a range of $15.20 to $15.30.
Which represents roughly 16 to 17% EPS growth year over year.
That's impressive.
For a physical equipment manufacturer dealing with raw materials and complex supply chains, compounding earnings at that rate is exceptional.
But here's where it gets really interesting.
Okay.
If we go back and look at that $12.1 billion backlog we talked about at the beginning, because to me, raising guidance for the current year is great, but the backlog tells a much deeper story about the future, doesn't it?
It fundamentally changes how management can operate the business. This raises an important point about how we evaluate corporate risk and visibility.
Because the sales are already essentially locked in.
Precisely. In most industries, leadership teams have to wake up on January 1st and figure out how they are going to market, pitch, and sell enough product to hit their targets for that year. It's a constant treadmill.
Right, they start at zero.
Exactly. Trane doesn't have to do that. They already have $12 billion worth of customers waiting in line for their products. As management states in the presentation, that backlog gives them exceptional visibility into 2027 and beyond.
So they don't have to worry about demand generation. They just have to focus on execution,
Yeah.
on building the equipment and shipping it out the door.
Yes, and think about what that visibility allows them to do mechanically behind the scenes.
Like what?
Well, when you know exactly what you need to build for the next 2 years, you can go to your suppliers for copper, steel, and microchips and negotiate incredibly favorable long-term contracts.
Oh, that makes sense.
Right. You can plan your factory expansions with absolute certainty, knowing the demand is already on the books to justify the cost. And you can commit to returning all that capital to shareholders without worrying that a sudden, 3-month dip in the broader economy will leave you starved for cash.
Yeah.
That backlog isn't just a big number to brag about on an earnings call. It is a massive strategic moat that actively de-risks their near future.
So, bringing this all together for you listening, Trane Technologies is proving something really vital about the modern economy. We are so conditioned by the headlines to think that high growth, paradigm shifting returns only come from the digital realm, from the apps, the software, the code.
Yeah, the flashy stuff.
Right. But Trane is proving that physical infrastructure companies can post tech like growth numbers if they are positioned correctly. By being the highly engineered cooling engine behind the data center boom, they are riding the exact same wave as the AI software giants. And because they have the sheer cash flow to aggressively reinvest in their own capacity, they can weather regional geopolitical storms in places like the Middle East or China without missing a beat on their overall growth trajectory.
I want to leave you with a final thought to mull over regarding this dynamic between the digital and the physical.
Go for it.
We hear constantly about the software side of the AI revolution. Everyone focuses on the processing power, the advanced algorithms, the new data models. But Trane's earnings report proves there is a massive physical bottleneck to all this progress.
Hmm.
You cannot compute what you cannot cool. If HVAC companies are seeing 130% growth spikes just to support the thermal management of data centers, what other completely boring legacy physical infrastructure sectors are quietly about to experience a high-tech renaissance?
Oh, wow.
Is it the companies making heavy industrial transformers? The manufacturers laying specialized high-voltage copper cabling? The digital future still has to be built out of steel, copper, and thermodynamics.
That is such a fantastic point to end on. We started this deep dive talking about how you probably ignore those rusty air conditioning boxes on the roof of your local grocery store, but it turns out the highly evolved descendants of those rusty boxes are the literal beating heart keeping the AI revolution alive. Thank you so much for joining us as we explored the Trane Technologies earnings report today. Keep questioning the world around you, keep looking for the physical realities hiding behind the digital headlines, and we will catch you on the next deep dive.